Hi everyone. Welcome to my Accounting for Investments lecture series. This topic, investments, is basically the second kind of deep dive topic that I tend to do when I teach my introductory accounting class. And the reason for that is because similar to inventory, which was my first deep dive topic, there are going to be things that arise from transactions involving investments that are going to kind of give us a need for a more complicated income statement. And so that's kind of the trajectory we're on is, we covered the accounting cycle, we covered basic financial statements, and now we're kind of building our way toward more complicated financial statements with the income statement being first up. And as you'll see here, as with inventory, there's going to be some useful information that can come out of investment transactions that are better presented in a more, I don't want to say complicated fashion on the income statement, but in a more detailed fashion on the income statement. So that's going to be investments. This is the first video that kicks that off. And this video particularly is about equity investments. So what do I mean when I say an equity investment? Well, you have two types of investments. You have equity and you have debt. Equity investments is essentially when you are investing in the stock of another company. So you're just buying stock of some other company on the stock market. Debt investments are when you are essentially lending money to the other company. You are buying and trading in their debt instruments, and so that's a little bit different than stock in the sense of that there's a designated payout and that sort of thing, and it's a lender situation versus an ownership situation, and so I've divided up the topics because the accounting for equity investments, for ownership investments, is going to be different than the accounting for a lending situation, a debt investment. Okay, so let's go ahead and dive on into equity investments, and then in the next video we will talk more about debt investments. All right, I usually kick off my equity investment lecture with the poll that you see here on the screen. I ask, if you were the user of a financial statement, okay, so put yourself in the shoes of someone who is trying to make an investment decision. How would you want a company's equity investments, I write here the word stock investments, reported on the balance sheet? And I give you two options. At their current value, based on current stock price. So in other words, if you tune into the stock market channel on the day that the company prepares its balance sheet, whatever stock price their investment is listed at, that's what you want to see it valued at on their balance sheet. Or B, at a historical cost, based on the stock price at the time that the company purchased it. In other words, if they paid $8 for a share of stock when they first bought it and put it on their balance sheet, they don't change that, even if the going rate for that stock fluctuates. So as a user of financial information, which of these two scenarios appeals to you? So take a moment, pause the video if you need to, just think about it. Which of these two scenarios would you prefer? And when you're ready, unpause and I'll talk about it. All right, so for those of you who paused and came back or either just left it running because you already know how you feel about this, let me talk a little bit about the kind of the implications of these two situations. First one, at current value based on current stock price. Now, if you are going to display the stock at its current value, first of all, you have to choose what value are you going to display it at. Well, balance sheets luckily occur at a point in time, and therefore you are going to record the stock at the value at that point in time. What's a benefit of this? So at current value based on current stock price. For those of you who prefer this, you're probably thinking to yourself, well, it's more accurate, right? Or it's a better representation of true value. That's kind of the common answer I get when I ask students, why'd you pick A? These are the kind of the answers I get, because they say, well, it doesn't matter what you originally paid for it. The fact is that stock that the company owns is going up and down in value constantly. And so on the balance sheet date, if the price is different than what you paid for it, we'll tell investors that the price is different. That way they know that your value has changed in some way. So that's kind of the argument I usually see for answer A. However, I do get some students who argue B at historical cost. And often the reason for arguing option B is that those price fluctuations that have happened since the day you bought it are uncertain, right? The stock, yes, it may go up in value since the day you buy it. It may go down in value since the day you buy it. But as long as you're holding it, you technically haven't gained value or lost value. It's not till the day you sell it that value kind of comes to fruition. And so those changes that have occurred since the day you bought it, they're not, in the grand scheme of things, maybe they're not relevant because until you sell it, it doesn't become relevant, right? And so that's kind of the argument of, well, we'll leave it alone, right? Put it on the books at the price you pay for it and just let it sit there at that price until the day you choose to buy or to sell it and recognize some sort of revenue or loss at that point. So that's kind of the two arguments. There's no right or wrong here. It's an opinion. Students tend to pick option A. Okay, that's kind of the default. But as I said, some make a valid argument for option B. But there's no right or wrong. But here's where things are going to get complicated. I'm going to ask you a second question. As a user of financial statements, so put yourself in the same shoes, would you want the changes in the value of the company's stock holdings to be incorporated into net income? In other words, these uncertain fluctuations, because from one balance sheet to the next balance sheet to the next balance sheet, the stock price could be just up and down, up and down, up and down, right? Do you want all of that up and down stuff that's not related to the company actually doing its regular line of business to end up on the income statement and therefore affecting the company's net income? Yes or no? So again, take a moment, think about it, and then choose what you would like to see here. For those of you who are continuing on or just came back after thinking about that, again, there's no right or wrong answer, okay? And there are two ways to think about this. For students that generally answer yes, you do want to see these changes in net income. The argument is, well, the value has changed, therefore, company has had a gain or loss, right? Now, of course, again, it's not realized yet, but yeah, the value has changed and therefore the company holding the stock has had a gain or loss. So that's kind of the argument for yes, you want to see this on the income statement. The argument I usually see for no is, again, going kind of back to the prior slide, the value changes are not certain, right? Until you sell, the price could, if it went up, it could go back down. If it went down, it could come back up. If it went up, it could go up further. There's no telling what's going to happen. There's uncertainty. So the value changes are not certain, and therefore, therefore, no gain or loss until a sale occurs. So that's the argument for no here. The majority of students usually select no when I ask this question. Again, no right or wrong, right? It's just an opinion. But here's where things get a little dicey, because if I go back to the first question, the majority of students tend to select A. You want to see it on the balance sheet at its current value. But then they choose B. They don't want to see the value changes hit net income, because that's kind of a misleading effect to net income. And the problem is those two selections are in opposition to each other. If you are going to change the balance of an investment on the balance sheet, the only way you can do it is essentially by, if it goes up, debit the investment. If it goes down, credit the investment. But there's got to be an opposing debit or credit. And that opposing debit or credit is going to be a gain or a loss, which is going to hit the income statement. So if you choose A on the first poll, you are locking yourself into A on the second poll as well, whether you like it or not. And therein lies the problem here. And it's a difference in how you prefer to see the balance sheet presented versus the income statement presented. So it's just food for thought. Again, no right or wrong. However, there is going to be a right or wrong as far as what the financial accounting standards require companies to do. And that is going to vary depending on whether or not you're dealing with an equity investment, as we are in this video, or whether you're dealing with debt investments, as you are in the next video. So let's talk about what do accounting standards actually require. So first off, keep in mind, and I'm going to point it out right up here at the top. I put it in the title to make sure nobody misses it. Everything you're about to hear is based on an equity investment of a less than 20% ownership of the other company. And the reason for that is because once you cross the 20% threshold, you are believed to have significant influence over the other company. In other words, you can influence their actions, you could potentially influence their profits, and then of course then that flows back into your accounting system since you're a stockholder, and so things get a little bit dicey. The accounting changes at that point. Once you cross the 50% threshold, you are essentially the parent company of that other company, and then the accounting changes again. So for introductory accounting courses, I tend to focus on just the less than 20% ownership. Okay, so this is kind of just you have a minority stake, you have no influence, you don't own them, outright as a parent company. You are just a passive shareholder, essentially. Okay, so everything we're about to learn, less than 20% stake. All right, I already told you, equity investments are ownerships of another company's stock. We know that. As far as the balance sheet goes, now, we haven't gotten into balance sheet classifications yet. In fact, that's going to be coming up in a lecture series shortly following this one. And it used to be in the past that I would save investments until after I'd already covered the balance sheet. But I realized it makes more sense to cover them earlier because of the various impacts you're going to see that they have to the income statement. And so it's better to deal with them now than later. But just know, when we do get to the balance sheet videos, when we do talk about the balance sheet classifications, something we're going to find out is you tend to split up what's called your current assets and your long-term assets. And that's based on how long you're going to hold the investment. And so I just want you to know, for now, we'll deal with the balance sheet later, but for now, know that equity investments could be called current, they could be long-term. That's all dependent on what management's intention with the investment is. If management intends to hold less than 1 year, then we would call that a current asset. And if management intends to hold it longer than a year, then we would call it a long-term asset. Now, if management has a certain intention, are they locked into it? No, they could change their mind. They could say, oh, we're not going to hold this more than a year. And then a year comes around and they say, we like the investment. We're going to keep holding it, right? They can change their mind at any time. But based on whatever their intention is, they choose whether or not to put this as a current asset or a long-term asset. We will talk more about those classifications in my lecture series on the balance sheet. All right. They are recorded at fair value. And I have here, i.e. market value. So going back to those kind of class polls that I put out there, when you buy an investment, the price you pay for it the day you buy it is its going market rate. That's what it goes on the books for. Whenever you get to the end of an accounting period, you are going to adjust the value. You are going to update it to reflect whatever the market value is at the end of the accounting period. Whether up, whether down, doesn't matter, but you are going to show them on the balance sheet at their fair value, their market value. But this is the problem that I told you. If you are going to adjust something to market value, just the way journal entries work, the fact that debits and credits have to have offsetting amounts put to them, we are going to have to recognize something called an unrealized gain or loss. Okay, so gain if the price has gone up, loss if the price has gone down, unrealized because it's uncertain, right? It hasn't actually happened yet. Until we sell, it doesn't come true. But we do have a change in value. So it's going to go on the income statement. It's going to affect net income. But we are going to clarify for investors, this is an unrealized gain or loss. So they're gonna see that. Once you do sell, any gains or losses then become realized gains or losses, and they also affect net income. So basically, if you have an equity investment, any change in value hits net income, like it or not. And then I just have as a reminder down here, once you cross the 20% threshold and the 50% threshold, there's different accounting treatments. They're more complicated. They're covered in more advanced accounting courses than this. All right. As I did with inventory, I find beyond just that kind of overview where I just explained how this is all going to work, kind of the sneak preview of what's to come and give you kind of that conceptual basis of things, really just going through a series of examples helps explain the accounting for these items. And so for equity investments, if you think about it, there's only about 4 things that can really happen with those investments in a traditional setup. You can buy them. They could go up in value, they could go down in value, and you can sell them, right? Just about 4 things. And so we're going to walk through the accounting of those 4 things through a series of examples, just to kind of give you a clue of how this works. But remember, these are equity investments. They're short term, usually. You might hold them more than a year. You might actually hold them some long amount of time. But typically, because they are the stock of another company, because the price values change constantly, because a lot of times equity investments are less of a long-term investment than, say, a debt investment. When their price changes, you're going to update to reflect that price change. And as part of updating to reflect that price change, you're going to run the gains and losses, unrealized or not, through the income statement. So let's see how this actually plays out in action. Here we have an example, purchasing. Flyer Corp purchased a 5% stake in Blue Devil Corp on August 3rd, 2018. Blue Devil Corp has a total of 200,000 shares of stock. The average stock price at the time of purchase was $11 per share. Record the purchase of Flyer Corp's stake. So, first thing we need to figure out is, all right, there's got to be a value here, right? A dollar value going on. It didn't tell us how much money Flyer Corp spent, but you know if we make a journal entry, we're going to have to record the amount of money they spent in it. So I would say before we go any further, let's just figure out how much money did they really spend. We know that Blue Devil Corp has 200,000 shares of stock. We know that Flyer Corp bought a 5% stake. So the first step we're going to do is we're going to say, okay, 200,000 shares times 5%. Pull out my handy dandy calculator. 200,000 times 0.05. That's going to be 10,000 shares. So Flyer Corp is buying 10,000 shares of stock at an average price of $11 per share. So times 11 per share. Again, pull my handy dandy calculator out, times 11. That gives us $110,000. So $110,000, this is the cash spent, right, to acquire this stock. Now, did you have to spend cash? No. I mean, arguably you could trade some other asset for stock. But for the sake of this lecture series, we're just going to assume any stock transactions that are going on are occurring in cash, because that's the norm. The norm would be to buy and sell stock in cash. All right, so we know they spent $110,000 cash. So when we think about our journal entry, we need our date. So August 3rd, 2018. If cash is being spent, then we have a credit to cash for $110,000. What are we getting for that cash? Well, we're getting an equity investment, which is an asset that's going to go on our balance sheet. What is that equity investment worth? Well, on the day we buy it, $110,000. And that's all you have to do, right? That's the end of the journal entry. Give up cash, get the investment. You're done until one of 2 things happens. You hit the end of an accounting period and the value of that equity investment has changed, or you sell it and the value has changed, right? So either way, at this point, you're just in a holding pattern. All right, so here we go. We're going to get to the end of our first accounting period, which is going to happen on December 31, 2018. At that point in time, Blue Devil's average stock price is $10 per share. So it has gone down in value from the time we bought it. Record the unrealized loss from our stake in Blue Devil Core. All right, so the way we do this, there's a couple different ways you can do the math, but it all ends up working out to the same end number. You can look at it as, well, we originally paid $11 per share. It's now $10 per share. So there's a $1 loss per share. We know that we had 10,000 shares. We calculated that on the prior slide. And therefore, we have a $10,000 loss. That's one way to go about solving this type of problem. The alternate way to think about it, and this just comes down to personal preference, is if we back up real quick, we currently have an equity investment at $110,000. That was based on 10,000 shares at $11 per share. We could simply say, well, we still have 10,000 shares. Well, not $10,000, 10,000 shares. They are currently worth $10 per share, which means that the equity investment is currently worth $100,000, current value, minus $110,000. This is our book value, right? What we have it on our books at, for a $10,000 loss. All right, so two different ways to think about it. Either you can take the difference in the price and multiply that times your number of shares, or you can calculate the new value of the investment, subtract your old value investment, get your loss. Either way, it works out. So this is just a personal preference thing. All right, how do we record this loss? Well, it's an adjusting entry that happens at the end of the period, because that's when we're figuring this out, so 12/31/18. We know that we have a loss from the value going down, but we haven't sold the stock. So this is what's known as an unrealized loss. And so that's what I'm going to debit. And you'll be saying, well, why am I debiting it? How do I know that? Well, a loss is basically an expense. So when you think back to your rules of what are debit accounts, what are credit accounts, right? Assets and expenses are debit accounts. So when they go up, there's a debit. So here we have an expense going up. That expense is a special type of an expense called an unrealized loss, but it's still basically an expense. And so unrealized loss gets debited for $10,000. What's the credit that matches that? Well, it's the investment, right? This is an asset that has lost value. And so we credit that asset for $10,000. If we think about what that ledger would look like, right? We draw a little T and put EI for equity investment. It was originally worth $110,000, and now we are crediting it for $10,000, which means it is going to be sitting on our books at $100,000, which, as we calculated, is its current or fair value or market value. Plenty different words for the same thing. Okay, so that's making an adjustment should the value go down. Let's now fast forward to the end of the next fiscal year. And let's see what happens when the value goes up instead. So now we're at December 31, 2019. The average stock price of that investment is $12 per share. Again, you can go about it multiple ways. One way I could go about this is I could say, well, it's currently $12 per share. The last time we made an adjustment, we adjusted it to $10 per share, which means now we have a $2 per share gain times our 10,000 shares gives us a $20,000 gain. That's one way that we can go about figuring out what we need to record. The other way we could think about it is we have 10,000 shares that currently have a market value of $12 per share, current value. That means that this is worth an $120,000 investment, so that's the fair value of the investment, minus, here's where you have to look back and say, what is it currently worth on our books, right? It is currently worth $100,000. So minus $100,000 book value, right? That's what we mean when we say book value, the value on the books, leading us to a $20,000 gain. right? Same endpoint. You're going to get to the $20,000 gain no matter how you approach this math, because you're essentially doing the same math. You're just doing it in a slightly different fashion. So personal preference there. But either way, we'll get to the $20,000 gain. How do we record that? Well, it's 12/31/2019. A gain is basically a revenue. But remember, this gain has not been realized. We haven't sold the stock yet. So we're going to call it an unrealized gain, and that's going to be a credit because revenue accounts get credited for $20,000. The other side of this is the investment. Equity investment, $20,000, because that investment has gone up in value. So now our asset is going back up. So if we, think about our T account for that equity investment, we originally recorded at 110. We knocked it down by 10. Now we're debiting it for 20, which is going to put it back on our books at $120,000. All right. So there's only one thing left. We've done buy it, we've done down in value, we've done up in value. The last thing we could do is sell it. So let's check that out. On February 1st, 2020, Flyer Course sells the stake in Blue Devil Core for an average price of $14 per share. Okay, again, two ways you can go about it. It's trading at $14 per share. The last time we adjusted it, it was trading at $12 per share. So we've had another $2 per share gain times 10,000 shares. Gives us another 20,000 gain on top of the one we already recorded. Or we can think about it as, well, we have 10,000 shares times, we're going to receive $14 per share, meaning that it's a transaction total of $140,000. That's fair value. It's currently on our books based on the last slide, that ledger account I drew. 120 is the current book value, meaning we have a $20,000 gain. Either way you want to go about it, right? Gets the same outcome. 20 gain, 20 gain. All right, how do we record this? Well, it's February 1st, 2020. We are selling the investment. What are we selling it for? Well, they're paying us cash, $14 per share in cash. And so we have a debit to cash. That debit to cash, we calculated right here, right? 10,000 shares, 14 per share, 140,000 is what we're getting paid. So $140,000 to cash. The investment is going away, right? We have to take it off the books altogether. If we back up, you see that the investment, as of the last time we made an adjusting entry for it, is sitting on our books at 120,000 debit. To make that go away, we have to credit it 120,000. And so equity investment, 120,000. But notice the journal entry is not in balance yet because we're still 20,000 short on the credit side. But the reason we're 20,000 short on the credit side is because we also have to record the gain on sale, right? The $20,000 gain that we calculated up here. Now, notice I write gain on sale. It's not an unrealized gain anymore. It has come to fruition. We are selling it. We have a realized gain on that sale. And so that's how we tend to refer to that. So that is the selling process. Now, you may think to yourself, goodness, that's a lot going on, right? We had a loss of 10, a gain of 20, another gain of 20. But let's think about this in a bigger picture sense for just a moment. We originally bought the stock for $110,000. We have now sold it for $140,000, which means we have made $30,000 in cash off of these series of transactions, right? That was ultimately the end of the day what happened. Bought it for 110, sold it for 140, made 130, right? If you think about over the course of this series of transactions, what did we record? Well, we recorded a loss of 10. We recorded a gain of 20. These were, I'll put you loss, you gain, right? Unrealized. And then we recorded a realized gain of another 20, right? So if I put loss in parentheses there, we sum all those up that is ultimately a gain of 30. So essentially, by doing the accounting this way, we've tracked the value going up and down, up and down, up and down. But what we've also done is, over the course of the 2.5-ish years that this problem covered, we have recorded a grand total increase to net income of $30,000, which reflects ultimately the amount of cash we made on the deal, right? And so that's why it works this way. All right, now let's talk about the income statement for a minute, because I said part of the reason I deep dive into inventory and then investments is because these transactions affect the income statement in a way that we aren't necessarily used to up till this point in time. So over on the right here, you'll see all these green boxes is basically the last time I showed you this diagram, which was during the inventory lecture series. All these green boxes is stuff you've seen before. Sales revenue, take out your contra revenue accounts, gives you net sales, takes out COGS, gives you gross profit, take out op expenses, you get to net income. But here's the deal. Investments, unless you are an investing company, like unless that is your business, investments are not part of your operations. So any money made is not operating income. Any money lost is not operating expense, right? And so in here, what we've dealt with is, your sales, that's your operations. We've dealt with your operating expenses. Your COGS is technically your biggest operating expense, right? And so what this has kind of created a need for is, if you're going to be dealing in these kind of side jobs, these side businesses, you need a non-operating part of your income statement, something to separate for investors. Here's all the stuff our operations generated. Here's the stuff that we did on the side. And so that's what happens now. So you still have sales revenue minus the contra accounts leads to net sales, minus COGS leads to gross profit. You take out the operating expenses from gross profit, and now we have a new subtotal. That new subtotal is called income from operations. So essentially we're saying, hey, if you don't care about all of our side businesses, look at this line, because this is telling you what our operations did. After that, we are now going to add a section for the non-operating revenues and expenses. And it's in those non-operating revenues and expenses where all of those unrealized gains and losses, as well as the realized gains and losses from these investment transactions, are going to wind up. They're going to go in this non-operating piece. And then once you take that out, you get to your net income. Okay, so again, pushing us toward this need for a more complex income statement, and we'll see that in a very near lecture series. All right, that's it for equity investments. The good news is, the next video is going to go into debt investments. And debt investments, while they are more complicated than equity investments, now that you've got got your feet wet, right? You've got a feel for how investments work and this idea of the gains and the losses and all that. Debt investments actually should be easier to understand, although they will throw a few new complications in the mix. So I hope you found this video helpful. I hope you join me for my debt investment video that's coming up right after this, and I hope you have a great day.